You could be on track to miss out on $6,000 from the government, and you might not even realize it. President Trump's new 2025 tax law created a huge senior bonus deduction, but because of some tricky income limits and urgent deadlines, millions of Americans might get nothing. The new law, which went into effect in early July of 2025, is complicated, and that complexity is what could cause you to lose out on this benefit for good. This isn't some permanent rule change you can figure out in a few years. It's a temporary 4-year window of opportunity. If you don't pay close attention to the details I'm about to share, you could miss out entirely. I'm going to show you how to make sure that doesn't happen to you. This isn't just a few bucks. It's thousands of dollars of your hard-earned money. I know that when most people hear new tax law, their eyes glaze over, and that's perfectly understandable. The tax code can feel like it's designed to be confusing, but my promise to you today is to give you a straightforward, no nonsense explanation. We're going to break down the 3 simple things you have to know to claim this cash. First, what this $6,000 deduction really is. The urgent part you must fix now. Second, the crucial eligibility rules and the hidden income caps that are the biggest trap for taxpayers. And third, the exact steps to take before the deadline hits. Section 1. What is the $6,000 senior bonus deduction? Let's start with the basics. What exactly is this new benefit? For every dollar you earn over that limit, you lose a piece of the deduction. To put it simply, the new law creates a brand new, extra tax deduction specifically for people who are age 65 and older. For an individual, it's a $6,000 deduction if you're married filing a joint return. It's important to understand what a deduction means. It isn't a check the government mails you. A deduction lowers your taxable income. Imagine your income is a big pie, and the government takes a slice in taxes. A deduction makes that whole pie smaller before the government takes its piece. So a $6,000 deduction means the IRS basically pretends you earned $6,000 less than you actually did, which can seriously lower your final tax bill. For most people who qualify, claiming it should be pretty simple. It will be a new line on your tax form, either the Form 1040 or the Form 1040 Senior for seniors. You just need to be sure that you or your tax preparer knows about this new deduction and fills out the form correctly. To be eligible, you'll need to include your social security number, and if you're married, file a joint return. Now, you might be thinking, don't seniors already get an extra deduction? And you'd be right. Before this new law, if you were over 65, you already got an additional standard deduction. For 2025, that amount is $2,000 for a single person. If you're married, it's $1,600 for each qualifying spouse. The key here is that this new $6,000 deduction is a bonus. It's in addition to the one that already exists. It's taxed right on top. This entire program, this generous $6,000 bonus, is temporary. It's taxed on top of your other deductions and can dramatically lower your tax bill. If you're a single filer making near or above $75,000 or a married couple making near or above $150,000, you are at risk of losing this benefit. You need to project your income for this year and make a plan. If you have a parent, a grandparent, a neighbor, or a friend who is over 65, please share this with them. You could be saving them thousands of dollars. They are currently on track to miss. The rules are confusing, but the stakes are incredibly high. For more breakdowns on how to protect your retirement and make the most of your money, please subscribe to the channel. Don't let a simple lack of knowledge cost you your hard-earned savings. You have to see it as a 4-year window of financial opportunity from 2025 through 2028. This 4-year window is a critical planning opportunity that you can't afford to ignore. This is especially important for those of you who have some control over your annual income, maybe because you haven't started taking Social Security yet, or you are not yet required to take required minimum distributions runs from your retirement accounts. As the law is written right now, it is only available for 4 tax years: 2025, 2026, 2027. That could mean doing a Roth conversion in a year when your income is lower, or carefully planning when you sell investments that could create a big capital gain. For the next 4 years, the government is giving you a huge incentive to keep your taxable income down. Planning for it now could save you tens of thousands of dollars over that time. and 2028. After you file your 2028 tax return in early 2029, it expires. It goes away completely unless a future Congress decides to extend it. This is where the numbers get powerful. For 2025, the regular standard deduction for a single person is $15,750. Add the existing senior deduction of $2,000, and you're at $17,750. Now you pile this new $6,000 bonus on top. Suddenly, a single person over 65 who qualifies has a total standard deduction of $23,750. For a married couple where both spouses are 65 or older, the numbers are even better. They get a $31,500 standard deduction, plus $3,200 for the existing senior deduction, $1,600 for each of them, plus the new $12,000 bonus. That's a total deduction of $46,700 before the government can touch a dime of their income. Here's another really important detail. This new bonus deduction is available whether you take the standard deduction or itemize your deductions. This is a huge deal because these kinds of extra deductions are often limited to people who take the standard deduction, but the law makes this $6,000 bonus incredibly flexible. So you can claim it even if you have a lot of other deductions to list out, like mortgage interest or large medical expenses. Section 2, who qualifies? While this law doesn't technically do that, this new deduction is the tool they use to get a similar result for many people. For a lot of seniors, especially those with lower or middle incomes, this new larger deduction will be big enough to wipe out their entire federal income tax bill. This means they effectively won't pay tax on their Social Security benefits. In fact, one analysis suggests that nearly 90% of seniors receiving Social Security will pay no federal tax on their benefits because of this change. But it's not because Social Security income itself was made tax exempt. It is because this powerful new deduction lowers your total income so much that you might not owe any tax at all. This is the most important part of this breakdown. This is where people are going to make the mistake that costs them $6,000. Just because this deduction exists doesn't mean it's automatic. There are two main hurdles: your age and, more importantly, your income. The age part is simple. You have to be age 65 or older by the end of the tax year, December 31st, 2025, to qualify for your 2025 taxes. If only one spouse in a marriage meets that age requirement, you can still claim a $6,000 deduction, but not the full $12,000. Now for the trap, the income limits. This is the hidden part of the law that can trip people up. This deduction is not meant for high-income seniors. There is a strict income test, and if you earn too much, this benefit shrinks or disappears completely. The income they look at is your modified adjusted gross income, or MAGI. For most people, your MAGI is very close to the adjusted gross income AGI you see on your tax return. Here are the numbers you have to know. For a single person, you get the full $6,000 deduction only if your MAGI is below $75,000. For a married couple filing jointly, you get the full $12,000 deduction only if your combined MAGI is below $150,000. Once your income goes over those levels, the deduction starts to phase out. For example, let's say you're a single person, age 68, with a MAGI of $85,000. You're $10,000 over the $75,000 limit. The law states your deduction is reduced based on how much you are over the limit. In this case, your $6,000 deduction might be reduced by $600, so you could only claim $5,400. Now think about a couple with an income of $200,000. They are $50,000 over their $150,000 limit. Their $12,000 deduction could be cut in half. This is the fix this now part of the title. You need to look at all your income sources, your pension, retirement account withdrawals, any part-time work, your investments, and figure out what your income is likely to be for 2025. If it looks like you'll be near or over those phase-out limits, you have a small window to make some smart moves. Can you put off a retirement account distribution? Can you shift some income into next year? Managing your income to stay below these thresholds is the most important thing you can do to get this deduction. Section 3. How to claim it and the critical 4-year deadline. So, how do you actually get your hands on this money? But the bigger story here isn't just about filing your taxes, it's about the deadline. You can't just treat this like any other tax rule. For these 4 years, it might be smart to manage your income to stay under the $75,000 or $150,000 thresholds. Let's also clear up a common misunderstanding many people heard President Trump promise to get rid of taxes on Social Security. So let's quickly recap the three things you must remember. First, this is a new temporary $6,000 per person bonus deduction for Americans age 65 and older. Second, you have to check the income limits. And third, this is a limited time opportunity. The deduction is only on the books for 4 years. This information is too important to keep to yourself.